but she always knows her place. She's got style.
The Lyn Rowe theme song, She's a Lady. Welcome to the program, 844 Ray Show. If you want to talk about dough, I've got a CFP, a certified financial planner, that I've known for, since that song was popular. Lyn Rowe. You know what's scary is you and I do remember probably every word to that song.
My older brothers listen to this a lot.
Yeah, oh yeah, sure. Lyn Rowe, CFP, in-house. I don't know if you got a chance to catch what I was talking about, but I do know this. I know that over the years that you and I worked together, we built portfolios for individuals based on having a minimum of a 15-year time horizon of relatively safe assets from which to derive an income. Not because that was so ingenious to make them rich. It was pretty ingenious to make sure they didn't go broke, because during the last 15, 20 years, we've known each other for 20 years, we've had some pretty hellaciously bad times.
Oh my gosh, yes. And that strategy was so brilliant. I mean, I watched people who didn't follow the strategy. They thought about it, talked about it, oh, I can do that. And sure enough, they didn't. And I watched them rue the day that they didn't. And then I watched people who said religiously, okay, I trust the strategy, I'm going to stick with the strategy. And oh my gosh, their whole lives were different.
I'm going back in time. Lyn Rowe worked with some major corporations around the country, which will remain nameless. But many of these folks were getting pension buyouts and big lump sums. And this was all the money that they had. I mean, they weren't rank and file, but they were middle executives. And of course, with their 401k and the pension buyout, they ended up with a fairly sizable amount of money. And they were going to you. And I mean, that's a huge responsibility.
It's a huge responsibility. And, one of the things that we heard a lot, Ray, back in those days was time the market, get in, get out. When do you buy? When do you sell? And the key is you don't try to time the market, because it backfires on you every time. You have that 15-year strategy on some of that money, and then you have money that you absolutely know can give you an income, and then you've got pretty darn sure money that is growing in the meantime, and then you've got the long-term money. It sounds simple, but trust me, a lot of people just did not get it.
And over the course of years, Miss Lyn Rowe said, I'm doing a pretty good job for these people. Certainly, they were retiring in their, early 60s, mid 60s from major corporations with a decent amount of money. But, there was one thing, and we're going back 15, 20 years now, one thing that was really lacking in the overall plan. And that was covering the healthcare side of things, because here's what happens. When you're a CFP like Lyn, you're an advisor, you focus so much of your time on money management, even on strategy withdrawals and 4% rules and tax planning and all the other stuff that you do. And a lot of us, myself included, tended to forget about some of the most important things, especially in retirement, and that is health. And not everyone's health is spiffy throughout the retirement years. So you developed a focus on not only helping people retire comfortably from an asset standpoint, but also making sure that you carved off enough money for the healthcare side of things.
Well, it was like bookends, Ray, when you think about it. You had the safe money that was generating the income, and you had pretty safe money that was generating some growth, and then you had the long-term growth money, which is, of course, a little bit more risky. Well, then you got a bookend at that back end, and that is a safe plan to take care of you in the event that you have those health problems. And frankly, I can't tell you the peace of mind it's given my clients over the years.
I'll bet it's given you peace of mind too, because in this business you take it personally. When one of your clients dies, for example, and you go, geez, I could have talked to him about life insurance, but I didn't. And you want to shoot yourself, because it's crazy, because you left a spouse or whatever destitute, or with $200,000 when it could have been $1 million, and at a cost, at a negligible cost. And so there really is this so-called fiduciary, we hear a lot about the fiduciary responsibility that advisors have with respect to, making sure that the fee structure is right, and making sure that they cover all the asset allocation bases, et cetera, et cetera, et cetera. But what about the fiduciary responsibility for making sure that the customer or the client is protected in the event of a premature death or long-term health care? Why isn't the media talking about that fiduciary responsibility.
It's just not sexy enough, Ray. Let's face it. Nobody wants to think they're going to get sick. And as Jean has said many times on this show, you're not getting out of this life without getting sick, for the most part. That's just not going to happen.
I am.
And so I understand.
I've got this mutual suicide thing going on with Jeannie, and it's just not going to happen. I just don't want to. I don't want to have to put her through it, which is why some years back you sort of twisted my arm, kicked me in the butt, and I physically wrote the check, which is so hard to do for long-term health care. Well,
it is hard to do initially, but you know, after a while, it becomes like any other thing that you need to take care of, and you know it. You know in your heart of hearts that spending capital is not as prudent as spending some of the return to make sure that you've got that safety. And that's all we're asking people to do is really spend some of the return, Ray.
Here's the idea that I've been working on. And to be honest with you, it takes me a long time. I'm sure like most of your clients, I procrastinate just like anybody else. But here's a strategy that I've been working on. I've been working on a strategy that says, what do I want to leave my kids? Because I do want to leave them with some money, and my grandkids in particular with some money. And let's just say that's $1 million. And I had my buddy Brian Johnson, you know Brian.
Right.
I had him run me a little illustration. And for $12,000 a year, for $1,000 a month, sounds like a lot of money, but in return for the $1,000 a month, I can name my kids or grandkids as beneficiary on a $1 million second to die insurance policy.
Wow.
So what I could do is I could spend let's say I had, you know, $1 million in the bank, right?
Right.
And with my Social Security and pensions and income from that $1 million, I could spend that $1 million down to zero.
Yeah.
I could spend it down to zero, and on the day that the second of us died, poof, there'd be $1 million left in the bank for the kids.
Fills it all up again.
And so when you start thinking about 4% rules and 2.8% rules, I'm going to talk about that next hour, I don't need to worry so much about that. What do you think of my strategy, Miss CFP?
I think it's wonderful. Again, getting back to spending a portion of that return to make sure that you protect that capital makes enormous sense.
Now, when we come back from the break, I'm going to do the mathematics on that and explain to anybody that's in their 60s or 70s that if you're married, putting money into, say, something safe like a tax-free municipal bond or investing in tax-free municipal bond funds and stuff like that year after year is a dumb thing to do. It's not dumb. I don't mean to say it's dumb. What I do mean to say is it's stupid. What I mean to say
it's not as
is
prudent.
There may be a better solution if that money is intended to be left to the heirs. I'm not talking about those that need to spend the income. I'm talking about those people that are kind of like me that say, you know what? I don't want to lose any money. I don't want to put it in the market and risk it. I'd like to get a decent rate of return, a few percentage points. Tax-free munis will pay me 3% for the next 30 years while I'm still alive. Well, let's take a look at that when we come back with Lyn Rowe, certified financial planner. In fact, you can go to her website if you want to learn more about long-term health care. I want my LTC.net. I want my LTC.net. She's the best. She helps me, and she'll help you, but she's co-hosting with me for the next segment, so don't go away. It's the Ray Lucia Show. Smiling is Lyn Rowe. She's the lady of the house, at least this house. Welcome back, folks. The Ray Show, 844-RAY Show is the number if you want to get on board. Now stick around because in just a couple of minutes, Miss Lyn Rowe, certified financial planner, and I are going to show you a strategy that will, I think, blow you away in terms of how you can get a safe and guaranteed return if you'll only tell me when you're going to die. Stick around. It'll be just a few minutes. Let's take a call. What do you say, Lyn? You up for it?
Sure. Absolutely.
Out to Redwood City, California. Let's talk with Dan. Dan's on the line. Hey, Dan, what's going on?
Hey, Ray. Yeah, so my question is I have some money just kind of sitting around in my bank account, and, you know, I maximize my 401k and my Roth, and I'm just kind of trying to figure out what I could do with that. You know, the stock market's obviously really high right now. I've kind of been thinking about real estate, curious to see if you're kind of bullish on that. But I guess my question specifically, if it did go to real estate, would be, would you recommend buying a property outright, or would you potentially use the money over like 2 or 3 properties and just put, like 20 to 40% down?
Yeah, great question. I obviously would prefer that you diversify, but when you buy real estate and you put 20% down, you buy 3 properties, you now have 3 mortgages and 3 liabilities. So a lot of that has to do with the ability to withstand a really terrible, bad market. So let's talk about that. How much do you earn, Dan?
Probably, I have a sales job, so it can kind of vary, but probably like 130.
All right, and how much of that 130 do you spend each year?
I don't know. I save a lot.
Okay, so when you do the math, I like the idea of having more than one property or buying into a managed portfolio, and there are lots of different ways to do that. But, if you pick the wrong house on the wrong block at the wrong time, it can be pretty financially devastating. You may need to feed that beast for 5, 6, 7, 8, 10 years to get your money out of it. So here's what I always used to do. I would look at the rents from the last couple of bear markets and see how much you'd have to reduce rents to in order for you to be the cheapest guy on the block so that you could rent your place out ahead of anyone else. And the deficit, then you look at your budget each month and you say, can I afford that level of a deficit for a year or 2 or 3? And if the answer is yes, then I think buying a property is fine, because let's face it, real estate is a great place to invest money unless you don't have the staying power. It's like anything else. But with interest rates as low as they are today, it's hard for me to tell you not to do it. I would just suggest to you to take a look at the worst case scenario, not the best case, all right?
Okay, but would you say it's better to get a couple of them instead of paying pretty much outright on one?
Again, let's go back. If you bought 3 properties and you figured out what the rental rates were during the last recession or 2, and you rented the place out with your 20 or 30% down for that low amount, and you calculated the negative cash flow that you have on all 3 of those properties, and you had 6 months worth of expenses in the bank and all that stuff, I would prefer that you do 3, have the leverage, and have the diversification. But if you can't handle the negative, then I'd prefer you do none or 1 at the most. All right?
Okay. Yeah. All right. Thank you.
All right, pal. Thank you very much for the call. Lyn Rowe, you agree?
Yes, oh, absolutely. I can't tell you how many times I've heard people talk about being property poor. And what that means is they didn't look down the road. They didn't look at whether or not they were going to have to come up with money to pay a deficit. They didn't really do the math. And what you're saying is do the math. Do the math.
Speaking of doing the math, we promised everybody I was going to come back and do a calculation. So before the break, Lyn and I were talking about this strategy that I had come up with, because so many people my age say, you know what, I'm going to put my safe money into tax-free municipal bonds, and I want to leave that to my kids, my heirs, because I got my pension, I got my annuities, I've got my income taken care of. I'd like to leave some money behind. So I said, well, 30-year tax-free munis, if you go with the AAA rated type or the AA rated type, something that's safe, super safe, you're going to get about 3% today.
Yeah.
So let's say that my wife and I are in our mid-60s. Would it be fair to say that the second to die would have about a 30-year life expectancy at mid-60s?
Easily.
That puts you to 95 or 93?
Yeah.
So remember I said before the break, if I took $12,000 a year, I could put it into a second to die tax-free life insurance policy upon the death of the second of us to die, right?
Yes.
So instead of taking the $12,000 and putting it into the second to die policy, which would guarantee that on the second death, the kids would get $1 million tax-free,
right.
I put the same $12,000 in payments. I'm going to put it in this, on the screen here for the TV viewers. $12,000 in payments for the next 30 years. I'm 95 now.
Right. We
get that 3% on the tax-free municipal bond. And I die, then my wife dies. The kids get $570,905.
Right.
If I'd have bought the second to die policy, the kids would have gotten $1 million. Why would anyone who's thinking about leaving anything behind to their heirs do anything short of that? It's just, it blows me away how the insurance company, now you obviously spend a lot of time with insurance companies, how they can do that. I guess it's the law of large numbers, because some people are going to, you know, die longer or whatever, but that's just phenomenal. What if I could get 4% of my money, right? If I could buy a 4% muni, take a AA rated or a single A rated bond. Now I'm at $673,000. What if I got 5% of my money? Now it's $797,000. What if I got 6% of my money? It's $900. It's over 6% guaranteed tax-free, unless I live or my wife lives longer than 30 years, starting at age 65. I mean, what's the odds of one of us making it beyond age 95?
Much bigger than people want to know, frankly. We have.
But that's the whole point.
Yeah.
I would love for this return to be, you know, 4% instead of 6%, because that means one or the other of us is a centenarian.
Well, you're using compound numbers here too. Are those munis really paying you a compound interest?
Well, that's right. That's a very good point. Unless you bought a muni fund.
Right.
And if you experience interest rate increases over time, you're probably not going to get anywhere near 4 or 5.
You're going to have volatility on that.
Okay, on the subject of insurance, your area of specialization, Lyn Rowe, certified financial planner in the house with me, is long-term health care. And you've got some very interesting things to say to individuals that think they can be the caregiver.
Well, I talked with a couple yesterday, and I said, what would you do if you know, assuming you don't do a plan, you don't have any kind of coverage, what would you do if he needs care? And she said, well, I'll take care of him. And of course, this young couple, and I said, you know, what if it's like 15 years from now? You know, you're going to be 15 years older. Are you really going to be up to the task? Because let's face it, you will still be taking care of him even if you have the insurance and even if it's enabling you to hire a caregiver. Because let's say the caregiver is coming in 8 to 10 hours a day, there's still 2 shifts left. And those are the worst shifts. Those are the shifts where somebody needs to get up in the middle of the night with cold muscles and be bleary-eyed and try to help somebody in and out of a bed, onto the commode without hurting their back. And that's why when we talk about caregiving for family members, it's important to remember that that's one of the leading causes in couples of depression of the survivor. It reduces the life expectancy of the one who is the caregiver, and the stress is just enormous. So even with a caregiver, you still will have a responsibility, but let's face it, the responsibilities will be you sitting and watching the game with him, you sitting and reading to him, you sitting and taking time with him to play cards or play a game.
Why are you making the him? Why are you making it the him? It could be the her too.
Oh, I always pick on the guys.
Okay.
You know that.
All right, all right. About 30 seconds. Go ahead. You
Well,
can finish up your train
my
of thought.
point is that the caregiver is the one that's going to be rushing off and getting the groceries and going through the refrigerator and looking in the expiration dates, fixing the meals, doing the laundry. They're going to be doing all the things that you won't have time to do and be the companion caregiver to your spouse.
You know, when my wife was in Africa for 2 weeks with her charity group this last summer, my refrigerator looked pretty bad. Let me just tell you that. I don't know what I would do without that woman.
Yes.
Lyn Rowe, certified financial planner. If you're interested in that strategy I just talked about, or in long-term health care, she does all this stuff. This is what she does. She's a CFP, and she's been doing it for a very, very long time. She's a lady. Whoa, whoa, whoa. Lyn Rowe. IWantMyLTC.com is our website. Give out the number real quick there, Lenny.
877-270-3127.
877-270-3127.